bad debts. Basically, these are two words, bad and debts. You know the meaning of bad. And debts means owings. O-W-I-N-G-S. Means the money payable. Here the debts means the owings to our firm. Means the money we have to receive in future. That debts have turned bad. What it means? It means, I try to explain this situation with the help of example. Suppose we sell the goods on credit to C. He is our customer. For rupees 5,000. And he promises us to pay the money after 2 months. But after 2 months, we are not able to recover the money from him. Whatever the reason, maybe he passes away, maybe he becomes insolvent, maybe he becomes dishonest, whatever the reason, but we are not able to recover the money. It means that is our loss, and the name of this loss is called bad debts. Please don't call it debts. It is debts. B is silent in this word. So naturally, bad debts is a loss for the firm or company. So it will reduce our capital in the accounting equation. So let's move to the next question. A starts business with cash rupees 5,000. Transaction number 2, purchased goods rupees 1,000. Transaction number 3, sold goods to C costing rupees 800 for rupees 3,000. Transaction number 4, cash received from C rupees 2,000. Number 5, bad debts rupees 1,000. And then closing stock as on 31st March 2013 rupees 200. So let's do the accounting equation one by one. A starts business with cash rupees 5,000. What it means? There will be increase in the capital plus 5,000 and increase in the cash rupees 5,000. Second transaction, purchased goods rupees 1,000. Nothing is written in this transaction. It means these are the cash purchases, not credit. So cash purchase means on one side we'll pay the cash and on another side we'll receive the stock. No effect on capital because purchase of goods, it's neither loss nor profit. So cash column minus 1,000, stock column plus 1,000. So the new equation will be capital 5,000, cash 4,000 and stock 1,000. And then sold goods to C costing rupees 800 for rupees 3,000. It means goods have been sold to C. Now you can see that they have not mentioned whether these sales are credit or cash, but they have mentioned the name of the party. I mean to say customer, and the name of the customer is C. It means these are the credit sales. If the name of the party has been mentioned, it will be called credit sales. So credit sales costing rupees 800 for rupees 3,000. It means we have earned 2,200 from this customer. It's a profit, it's a gain. So there will be increase in the capital plus 2,200. In cash column, nothing, but in stock, minus 800 because the stock worth rupees 800 has gone out. We didn't receive any cash, but we have received the promise. Or we can say we have created debtors. The customer to whom we sell the goods on credit basis and he promises to pay us in future, that customer becomes debtors. And debtors is an asset for us because any money to be received in future, that amount is our asset. So in the assets column, there will be new column that will be debtors. So plus 3,000. So the new equation will be capital 7,200, cash 4,000, stock 200, debtors 3,000. Now cash received from C rupees 2,000 because earlier we had sold goods to C on credit basis for rupees 3,000. Today we have recovered rupees 2000 out of that money. So when you recover money from the customer, it's not a profit. So capital, no effect, but cash will be increased by rupees 2000. So in the cash column, plus 2000. In the stock column, nothing. In the debtors column, minus 2000. Because previously, we had the debtors of rupees 3000. Today, we have recovered rupees 2000 from the debtors. It means it will reduce our debtors. So new capital 7200, cash 6000, stock 200 and debtors 1000 rupees. Now, bad debts rupees 1000. It means we have lost money from the credit customer. I mean to say from the debtors. It's a loss, so we'll reduce our capital by rupees 1000. So in the capital column, minus 1000. In the cash column, nothing. Stock, nothing. And debtors, minus 1000. So new equation will be 6200, cash 6000, stock 200, debtors nil. So this is the accounting treatment of bad debts in the accounting equation. Now, we have to prepare the balance sheet on the basis of last equation as on 31st March 2013. So the balance sheet will be on left hand side capital 6200 and on right hand side cash 6000, stock 200 and the totals on both sides 6200. Now one thing more, we have to calculate the amount of profit made during the year ending 31st March 2013. So the formula to calculate the profit is closing capital minus opening capital plus drawings minus fresh capital. You can see closing capital as on 31st March 2013, that was 6200. We have taken this amount from the closing equation. So closing equation contains the closing capital minus opening capital. In the beginning, the capital was rupees 5000 if you look at the accounting equation format. Plus drawings, there were no drawings, so plus 0 minus fresh capital. There was no fresh capital during the year. So minus 0, that is equal to 1200. It means during this year, this firm has made profit of rupees 1200. So in this accounting cycle, you can see how we can prepare balance sheet, I mean to say the position statement, as well as we can calculate the profit made by the firm during the year.